We are live on Grips, YouTube, and LinkedIn, and Alt Investor LinkedIn. Just waiting for Vivekam YouTube as well. I'm monitoring the feed, so awesome. I think we are live on Vivekam's
Yeah.
YouTube channel as well. I can see the feed. Awesome. Okay. Hello, everyone. Welcome to another session of the ALTXtra webinar, where we'll transparently discuss the differences between LoanX product and the P2P lending product from a retail investor's point of view. And today, to discuss this topic, we have an independent financial advisor, Mr. VVK Prasad. I'll quickly introduce Mr. Prasad. So, Mr. Prasad is the chairman and MD of Vivekam Financial Services. Vivekam is a product driven SEBI registered investment advisory firm based out of Hyderabad. Mr. Prasad is also a CA by qualification with over 38 years of experience in Indian financial markets. He was a partner in Motilal Oswal and headed the Andhra Pradesh operations from 2005 to 2007. Mr. Prasad is also the president of Association of NAC members in India for the year 2005 to 2006. He has a vast retail broking experience as well and thorough knowledge of capital markets. So it's fair to say that Mr. Prasad is a veteran in the industry, and he'll have a lot of wisdom on these two particular products, and then help them compare for everyone watching to make a decision with respect to where to invest them. Uh, I'll quickly introduce Vaibhav as well. Vaibhav Laddha is the CEO of Grip Invest. Grip Invest, as some of you might know, is a high yield investment platform offering fixed income investments to retail investors starting at just 1,000 rupees. Grip is one of the leading OBPPs and also one of the founding members of the OBPP Association in India. Vaibhav, over the last decade, has held multiple leadership positions, scaling early stage startups both in India and in the US, focusing on creating different products for the end user. He also holds an MBA from the Darden School of Business, University of Virginia, and is also an alumnus of IIT Delhi. Vaibhav and Mr. Prasad, welcome to this webinar. Pleasure to host you today.
Thank you so much.
Thank you, Yash. Thanks for inviting us.
Awesome. So I'll quickly set some context for the audience, because we are live for the first time on Vivekam's YouTube channel as well. In all our previous ALTXtra webinars, we have hosted representatives from platforms or companies offering these exotic alternative investment products. But this time, we are introducing a fairly new perspective for all of you. We have invited a seasoned independent financial advisor to provide an unbiased view of two different types of products. While Weber from Grip has joined us, the spotlight will today be primarily on Mr. Prasad. We don't want to let Weber speak unless anyone has a specific question for Grip. Today, along with Mr. Prasad, we'll be discussing and comparing the key features of the two products. Although they have a lot of similarities, but there are some key differences for investors. One is a LoanX product based on SEBI and RBI securitization of SDI guidelines, and the other product is P2P lending, which is again RBI regulated product. So stay tuned till the end of this webinar to get the maximum benefit out of it, and then decide how you want to make your decision with respect to these things.
Yash,
This is the eighth. Yeah, sorry. Go ahead,
before
Vaibhav.
forward, yeah. I am a regular on your alt webinars. I think I've spoken enough on your webinars. Today, I will be happy to take the backseat and will also hear, a lot of wisdom from Mr. Prasad. So, yeah, very happy to have you here, Mr. Prasad.
Awesome. Um, so this is the eighth webinar in the Alt Extra series, which is curated by Alt Investor. Quick brief about Alt Investor. It runs India's largest community on alternative investments. The Alt Extra series is proudly powered by Grip Invest. My name is Yash, and I am the host for this whole webinar series. While I will discuss some key questions I have on this topic, I request the audience watching, wherever you're watching this, there will be a question box or a chat box. Just put your questions in there, and my team will pick up those questions and put it forward to us, and we'll get them answered by Mr. Prasad or Vaibhav for you. Okay, all the housekeeping done. It's a lengthy process, but finally we are there. So let's get started. I'll directly come to you, Mr. Prasad. You've been a veteran of the advisory industry in both equity and fixed income products. Uh, why do you think people should, besides equity, diversify to fixed income or any sort of other alternative products?
Now, simple thing, Ash, all that people have to understand is whether you call it fixed income investment or kind of variable income investment, the objective is to earn a little rupee, 1 rupee more than what other traditional schemes are offering. But unfortunately, in most of the cases, of the minds of the people, they are completely risk averse. They don't want to take the risk on their side, though the returns are slightly higher on variable instruments like mutual funds and equities. In fact, if I can tell you the numbers wise, if there are two people who are coming to us with an open mind to talk about equities and mutual funds, there are 8 people in the horizon looking for fixed income options. And when I talk to them, when I ask them what are the options that are known to you, very few of them know anything more than bank deposits. And some of them do know about the chits because in South India, chits are very popular instrument of saving.
Hmm.
And apart from that, they don't have any other clue. They only say this. And at the most, they say mutual fund, I think they also offer debt schemes. But when I tell them, do you know that they also can go down in value if the interest rate goes up? They say they don't know. They think it's like, lending money and then expecting some inflow to come in. Then I tell them, you cannot expect mutual fund debt schemes to continue to reward you like a bank deposits, where bank deposits, you are parking money with the bank and you get the money at the end of the period. So there is no kind of variability in the returns expected unless you prematurely close it. But in debt instruments, unfortunately, the longer the term, if you take a debt instrument, a debt a mutual fund, and then hold on to that, if the interest rate goes up, your value goes down, and then you may lose even 10% of your principal. Well, you are happy with around 8% interest on that. So many people are confused. So they say we would like to stay with the banks. Then I was literally dying to look for an alternative investment for the retail folks because end of the day, as an advisor, my primary goal is to make sure that the investors have smiling faces without adding risk
Hmm.
against their kind of bent of mind. So Vaibhav walked into our office sometime in the last 1 year before or 1.5 year before, and then we had a detailed discussion. And I must congratulate and also compliment Vaibhav and his team because this mechanism was available in the exchange for a long time, but nobody ventured to get into that. When he told me that he is trying to get into this, I immediately embraced. I said, I will introduce it to all my clients, all my people. And in fact, I commit in front of all of you, I will try continue to pursue this line of activity for most of the investors for the several advantages that it carries. We'll discuss it as we go along. But at this point of time, I can say fixed income options, if you are trying to add a little more risk at this point of time, I can say if I give the money to a bank or if I give the money to an NBFC as a deposit, I do not know where the money is parked. Simple,
Hmm.
straightforward. So I do not know whether I can take the risk that is automatically involved and inbuilt into that, or whether I'm just banking on somebody gods that somebody will take care of protect my property, and in case the bank goes bust or NBFC goes bust, they will come and repay me, which is not the case. Even the banks will only pay me 5 lakhs, not more than that, which means theoretically people believe that banks are infallible, they will not fail. But practically, if you are really open minded, private banks can also fail, even commercial banks, public sector banks also can go bust. Unfortunately, in India, that is not the feeling people are carrying. But if anybody reads the regulations well, they know 5 lakhs is the maximum amount they can get in case something adverse really happens, something like nuclear bomb somewhere goes wrong. We are not going to get more than 5
Hmm.
lakhs. That's the simple thing. And I think from that perspective, the risk adjusted return that SDIs being offered by GRIP or LoanX kind of proposals are definitely much better. We will definitely delve into other discussions like why P2P lending is important or not important. We'll in the discussion as the discussion goes forward.
No, thank you, Mr. Prasad. Very, very helpful. Clearly, the awareness for fixed income products or the variety of fixed income products available to a retail investor is very low. And this webinar is meant to solve for that. People should at least be aware that another option to bank FDs do exist out there, and maybe people should explore them and then decide for themselves whether they want to invest in it or not.
And
So,
Yash,
uh,
and Yash,
yeah, go ahead. Go.
last couple of months have also again shown the volatility in the equity markets. And
Hmm,
for retail investors, like the entire year there was this sentiment of bull phase, but
hmm.
then last 2 months have clearly shown the volatility of equity markets. I think that is also one reason why some kind of portfolio diversification into fixed income is necessary.
Definitely. No, agree to that, Vaibhav. Um, so we talked about SDI a little bit, Mr. Prasad. So let's go into that question directly. Can you explain LoanX, which is an SDI, for your audience, and then also P2P lending for the audience?
I will. See, first thing is, like P2P lending, I'll take up first, and then I'll probably go to LoanX because LoanX is, according
Sure.
to me, superior product. So obviously, it should go at the, it should come at the end. P2P lending is, it was very rosy. It was very extremely well designed initially when we started rolling out to our pro clients, and we told them we embraced the concept. There, the P2P in the present form was not the same thing that was offered to the clients before. When it was first offered to the clients, we said you can park the money in something like a mutual fund in P2P platform, and they will find the kind of borrowers and who will have more than 750 credit score, and it will only be lent to them. That means in this case, in P2P lending, unlike in banks where you do not know where your money is finally getting parked, you will know where your money is finally getting parked. And next thing I also told my clients was it will be distributed to not less than 200 people. So the risk of default from so many of them is very, very less because unless more than 10% of them default, you will not suffer even interest loss. That was the principle. Indirectly, what was happening was P2P platforms against the intentions of the RBI because we were not very sure about the entire intentions and the entire nomenclature that preceded that. So they took the risk upon themselves and they were charging 13% interest to the ultimate cash receiver. And when they're passing on, they were only passing on around 10, 11%, which was fine. It makes business sense for them. But for our clients, what happened was in between, because they were taking 2.5% of the cushion between these two people, borrower and the lender, they were able to bear the risk of default. That is why we advertise and then we also announce the people option to the retail. Lot of people invested. Everybody was happy. And then the bombshell dropped. Then the RBI said, you cannot do this. And they started penalizing the P2P platforms. And they said the risk has to be borne, understood by the depositor at the time of lending money. That means the link of intermediary between the borrower and the depositor has suddenly disappeared. Now what happened is if one guy defaults, obviously the entire thing will be passed on to the people who lend money to them. And matching is not a simple thing. And as soon as it happened, what has resulted in our system was if the risk is going to be absorbed by the people who are lending money, who have not seen the borrower any time in their life, who do not understand analyzing the financial statement themselves, that is like exposing them to the completely real wild guess. So I said we will have to stop it. Fortunately for us, RBI has not been so strict to stop the business and then cut off everything. They said existing cash flows let it continue. So fortunately for us, not even one investor who invested in P2P lending through our one of our chosen platforms have not lost any money. Everything is coming in time. Everything is being paid back also. That's not an issue. But as against this LoanX, in this what happens is in P2P lending, I only know the possible borrower profile, not even the name of the person, because they would not be required to disclose the name of the borrower. So I do not know whom they are being lent. And in with this LoanX, what happened was when the Vaibhav and team came to us, they brought forward a proposal where personal loans, gold loans, or loan against property, or MSME loans, like there is an NBFC which is in the business for the last 10, 15 years, and who have got a habit of living, giving the money, raising the money, and then taking it back. And how this opportunity came up also, our investors should understand because then their perspective will be clear. Somebody is not trying to take your money without any bona fide reasons. So how it happened was when they lend money to the other people, earlier NBFCs can borrow money from outsiders and again lend it, again borrow and again lend it. It was a kind of recirculation. But recently what has happened was RBI came very strict on that and then said you cannot lend public money taken as a deposit to your loan borrowers. So you have to use your own money, indirectly saying banks or NBFCs, if you want to lend money to the people, you should have equity in your balance sheet to lend it to them. That makes it compulsory for all these NBFCs, including HDFC Bank. I'm trying to bring HDFC because people have to understand the real situation. When HDFC Bank was served a notice by RBI saying that your loan to deposit ratio was more than acceptable proportion, what HDFC Bank did was they pooled up X amount of loans together and converted them into security and offered it to a pool of investors like me or my group of people. Not to me, but I'm saying as an example to the people, and then said about 1,000 crores, give it to us. Now, when they transferred the loans to the outside borrower, outside depositors, what happened was from their balance sheet, the entire loan book disappeared in the HDFC Bank. Immediately, the loan to deposit ratio has come to acceptable level. When the banks are doing it, NBFs are already pioneers in that. They are already doing it. So, for example, in this LoanX platform, the people who were lent money, they are happy if they get their money for their businesses, they are servicing the debt. And now NBFC, something like LoanX platform, they pool up, let us say, 2,500 loans. I'm just giving an example of loans to given to MSME people. And when they take 2,500 loans put together, and all of them put together is, let us say, 50 crores of rupees is the money. Now, there are more borrowers interested to take money from the NBFC, but they don't have money in the form of equity. The only other alternative is they have to securitize this loan portfolio. That is what securitized debt instrument stands for. So obviously 2,500 loans are put together. They are collectively probably charging around 13 or 14, 15% interest to the borrowers. They are comfortably paying. What they do is, GRIP will do is, the LoanX pool of 2,500 loans is offered to the rating agencies and asked to rate how are the repayments, are they reliable. Then rating agencies will have to come up with either BBB or BB or A plus, A minus, whatever, the rating, going on the pattern of them. Because now there is a credit rating agencies. First, there is a borrower. First, there was a lender called NBFC. Now there is a platform which is willing to buy the loans from the NBFC. And credit rating agencies approving and then certifying that these are actually bona fide, trustworthy loans. And once they do that, GRIP will take the platform and then they split the whole 50 crores into small instruments called SDIs, and it may be 1,12,000 or 78,000, some number, depending on the number of units devised, and that will be offered to people like us, like my clients. And then I tell my clients, you have to earn more money than the banks. And how much more? Theoretically, you should at least hope to get double the money of the bank money. If the banks is giving you 7%, you should at least hope for 12, 13, 14% income on your fixed investments, because that is the prevailing rate in the market. Then how do I do that is the question that many of my investors ask me. I told them SDI. But there is a catch. As we go along, we probably will discuss. In banks, they are used to a system of parking the money, getting the money at the end of the period, like after 6 months or after 8 months or after 1 year. Then whoever comes to our office, we ask them, have you taken a loan in a house? Many people say yes. Or have you taken a loan on a car? Yes. Have you taken a loan on TV? Many people say yes. How are you repaying? We are paying EMI. EMI. So the moment they said EMI, I told them, boss, when you are paying something as EMI, everything you are paying is not only towards the loan. Something is towards the loan principal, something is towards the interest. When you already gotten used to paying the amount of principal and interest, why don't you open your eyes and then be willing to take money also in the same fashion when you lend money? If you give money to the bank, 1 lakh you give it to them, and then 1,07,000 at the end of the year, don't think that is the only alternative. That is the one alternative available. The other alternative is you ask them to give you cash flows every month. Just like EMI paying, you can get the EMI being paid to you. Then some people understood. In fact, honestly, still not many people have understood the concept clearly, but it is getting into their minds now. When I told them, but sir, there is going to be two problems in this. One is the reinvestment risk, because they also read the books. They tell me reinvestment risk, interest rate risk if it goes down, all kind of nomenclature they use and throw at me. I tell them, boss, the interest rate risk is there for everybody, not for you. It is not specially made for you. Reinvestment risk is there for you, provided When you get the inflows, if you don't have investment options opening up, there is a reinvestment risk. But in SDIs, every month after month, in fact, there are at least 4 or 5 investments opening up for subscription. That means if you invest money, when you get the cash flow, which is inclusive of principal and interest, if you want to use it for your needs, take the interest portion and use it. Principal amount to recycle it. In fact, we came up with an idea. I tell my clients, if you start your journey with around 12 lakhs of rupees investment at the time, at any point of time, normally the duration of SDS is between anywhere between 6 to 18 months time. So when you get to your, if I turn off the cash flows back, you normally end up getting about a lakh of rupees per month. That is normally the amount that is investments are opening up for subscription. So add few rupees more or subtract rupees more, you can recycle it. And to show them an example, I invested myself and I started tabulating it. My team works on it every time, every month to understand how much compounded annual growth rate I'm getting on my investment sequentially. So I am getting around 12.85% return on my investments for the last 1.5 years. So this is a standing testimony. All that I need to do is every month keep my eyes and ears open. What are the new offers available? Then check my bank account, how much is credited to my bank account. 1,12,000 is created, 98,000 is the instrument open, immediately put 98,000. It's okay. 14,000 is left in my bank account. Next month, 14,000 also add, another instrument opens, another invest. Only month, once a month, 2 minutes of my time is what it is taking to make me increase my income from banks of 6.5, 7% to almost like 13%. So I could double it. In fact, the sweetener is I tell you, if I invest in my bank account, because my regular flows come into my bank account, if I convert my money into my wife's account, and if I make her invest in SDIs, that is completely tax free. This entire 13% is tax free because you don't need to pay any tax on that. So that's what I've been telling my clients. And then a lot of NRIs also showing interest. They're coming and they're putting money in their parents' name. They say, we want to give an annuity to our parents who will put about some X amount of money and every month they want to get paid. I said, love it, do it, it's your duty. So the instrument is simple, straightforward, and if they don't understand, like your platform, like me, like Vaibhav, we are all available to offer a clarification. But many people try to believe that anything that is not in the public domain is risky. We have to answer. I really congratulate you for taking this initiative because we need to make people understand this instrument is safe, very, very safe. Once that message is conveyed, I think people will come forward.
I just want to say, Mr. Prasad said about HDFC Bank securitizing their loans, right? So this is again, there was a news that HDFC is securitizing 10,000 crore worth of loans, um, to manage their loan to deposit ratio, but um, they are going to sell this 10,000 crores loans to large financial institutions like mutual funds, other AMCs. I think Nippon and SBI Mutual Fund are in talks with HDFC. Now, before GRIP happened, this is how the securitized instruments were traded between large institutions. I think at GRIP, and what Mr. Prasad was saying, at GRIP we are trying to, our big USP is fractionalizing this instrument and hence making it accessible to retail investors. So yeah, I just wanted to add that.
I mean, honestly, it is a democratizing the investment income making options for retail clients. Unless the moment you believe that only rich people can have access to the larger investment options where they can make more money, that is not democracy. We are democratizing the whole principle where even retail investors also can participate in higher income earning capacity from fixed income. That's what this instrument can be termed as.
No, got it. No, thank you, Mr. Prasad. Thank you, Vaibhav, for your comments as well. I just want to bring back that question again. When you compare this product with P2P lending, you mentioned, Mr. Prasad, that LoanX can be MSME loans, personal loans, loans against property, vehicle loans, anything, right? P2P lending, is that only unsecured loans which are given out to individuals, or is it something else as well? Like, are they also gold loans, or are they secured? Are they unsecured?
It is 100% unsecured loans because RBI clearly said in P2P lending, you are supposed to lend to the people on their kind of caliber, I would say. Kind of basically, you have to appraise the personality and then lend the money without any security. In fact, if I may go forward one step, the liquid loans is the topic that we covered. In that, they don't even give it to the borrower per se. What they were doing was they were trying to identify the people who seek education loan and they go to education institution. They don't give it to the borrower who actually needed money to pay it. They go to the institution and then say, we will pay you all the fee upfront instead of paying in installments. You give us a discount. That discount was working out around 14-15%. That is what actually was being given to P2P loans. So in that, there was no question of security at all. Everybody knows it is only by mitigation of risk is done by diversifying across 1,000 people. So 1,000 people in unison cannot go defaulters. That's the normal principle. But that is completely different from LoanX, where the LoanX is the real money going to the real borrower based on the real business or on real security. And the security also is going to be offered to the trustee, and the trustee will split it into different parts and give it to that. Indirectly, something like a bank or NBFC is working to protect my financial interests in the loan. And that too, in fact, if I may add here, the LoanX platform comes with two other security layers also apart from the securities offered by the borrower. Number one is if the HDFC Bank example, I'm just taking some kind of HDFC Bank or some kind of Kirtana Financials or whatever, somebody who offers the loans to us, they want 50 crores of money to be given to them so that they can redeploy the money in the market. Then GRIP or the trustee on the behalf of all our depositors, they say, we will give you 50 crores provided not if you transfer 50 crores of loans to me, but you need to transfer 10% more also. That means 55 crores worth of loans have to be given to us. And in addition to that, sometimes what they say is you also have to give a bank guarantee to the extent of 10% of the exposure also. That means another 5 crores of bank guarantee or cash deposits also needs to be given. So how much security this group of people have got it? 50 crores of principal loans, 5 crores is extra layer, and another 5 crores of cash security. So 60 crores, that means 120% is the security given to them. As though this is not enough, the amounts that were lent to the borrowers may be at around 14 or 15%, whereas we are offering it to the depositors is only around 12.5 or 13%. The 2% excess spread will also keep coming to the trustee because once the loans are transferred, till the time the whole instrument is completely exhausted, all the cash flows will keep coming into the trustee. So that means we have three layers of additional security than the principal one. Additional security of 10%, collateral, and additional interest. All of them put together, the risk will be so very minimal because the default rate is less than 1.5-2% at any point of time. So the chance of somebody losing money is very, very little. And in addition to that, when I lend the money or deposit the money in a GRIP solution and then SDI and give the money to them, if there are three installments are given, my risk is seriously limited because the installment that is coming to me is not just the interest, it is also coming as principal. So obviously the interest rate, the repayment, if there are more installments coming in, the risk will drop dramatically. That is why these instruments are far more superior and there is a big disincentive for the borrower to default because he already repaid major amount of money. And it is easy to recover the balance amount. That is why the default risk is very, very less compared to P2P.
Mr. Prasad, I'd still like to ask in both the products, if a default happens, or in what scenario can people still lose money? And if I invest in a LoanX product and with all the security measures still present there, how can I still lose money? Like, in what scenario will I lose money?
See, the situation is simple. Something like a major catastrophe happening. Let us say their borrowers are all in the kind of one area in Gujarat, Latur or somewhere, and there is a serious earthquake. And if it is like MSME loans, all the industries in there go default. In that case, what happens is the repayments will be affected. In that cases, yes, there is going to be an element of risk. But is it not open for the bank? Is it open for anybody who is lending business? That is why it is always wiser to understand where the loans are actually distributed. Is it geographically one location or is it only to one segment of the people? If you understand, for example, gold loan, for instance, even if anything happens, gold loans cannot go default because you can sell the gold. No. So obviously, it is not possible for the default to happen if there is a security. Only if it is unsecured like P2P, you have a risk of losing money, number one. And in LoanX, the advantage is the cash flows may be impacted, but the defaults are very unlikely to happen because of the several features built into this. On top of it, as I told you, if there are 3-4 installments are already repaid, the chance for me or even the idea to default will be very, very disastrous for me if I'm a borrower. So that's the reason why,
Sure.
there's going to be compulsory obedience to the rules is implemented in principle, in the spirit, in LoanX and in the P2P lending.
Got it. Okay. Weber, any thoughts to add on to that?
Yeah, so as we established, there are three layers of security structure in a LoanX product. There's an extra cash collateral from the originator, then there is an excess interest spread, and then there is an over collateralization of loans. But your question was, with this security structure, how can someone lose money? What this security structure provides is that broadly 20 to 25% of the pool which we have selected has to default. Now, if you see your general usual NPAs for NBFCs, they are in the range of 1 to 2%. Maybe if you take like some exception in NBFCs, it will go to 3.5%. Here we are seeing that with this security structure in place, pool default of 20 to 25% has to happen for the investor to lose money, and that's why it becomes a very robust product before investors would lose money. However, uh, there is a reason that these are not AAA rated. There is still an outlier chance that the default can happen, which is that catastrophic situation where how would a 25% default happen? It can happen if, let's say, a complete industry goes belly up, or geographically a state, if a state goes into some stress situation. For that, what we do when we curate this pool of loans, when we cherry pick this loan book, we are cognizant of even this factor, and that's why we take care of geographical distribution, how distributed the pool is, how the CIBIL scores are, what is the fixed income obligation ratio for the pool, and so on and so forth. So a good quality pool, the security structure, and then the other 24, 25 parameters to geographically distribute and make it as diversified as possible are the things that are put together in this product.
Okay. Awesome. Thank you, Weber. Uh, Coming on to the next question, Mr. Prasad, LoanX versus P2P lending. How is the liquidity in the product, both the products? If I have to exit midway, how does that work?
I mean, you hit up on a very uncomfortable topic for Vaibhav probably, but not for me. See, number one, the moment you say liquidity, normally premature withdrawal is what actually people have in mind, because people who are coming into this instrument are with a mindset of fixed income investment where they want to deposit money and take the interest at the end of the period. If they want to exit, is there a possibility? Theoretically, yes. LoanX and kind of SDAs have a possibility because all these instruments are theoretically listed on the stock exchange. Do you find any trading happening? No, there's no trading happening. But does it mean that there is no way out? There are ways out. Only thing is, all of us, like you, Vaibhav, and all of us, and the entire community, has to put our brains together and come up with an idea where, for instance, I tell you, if the instrument is offering at around 12.5% interest only, or 13% interest for simplicity, and if somebody has invested with around 12 months of horizon, and after 3 months he got into a medical emergency, and he needed the money. And what can he do? He can go to the stock exchange, but it is hardly traded, so he may not be able to immediately trade. But people like us, we are pulling up a lot of retail investors to keep the money ready whenever some opportunity comes up. So the proposal that I bring forward to them is, if you as an investor want to exit after 3 months' time, you are entitled to get 13% return. Are you willing to take the money at a discount? Because if you are in distress, obviously you are supposed to be available to give a discount. Then if somebody says, okay, I don't mind taking 2% cut, I will be more than happy to jump in and then take up the equity and then pay him that percentage of money, amount of money, that I'll get 15% return on my investment. And when I can do that, I also want to be uniformly make it applicable to all the group of investors. So when we intend to do this, when we do this, we'll have a group of investors who lined up, and we will have a platform where we showcase so and so wants to offer 7,81,000 rupees grip investment or SDI for public. It is earning at face value of this instrument is now probably 7,81,000. If he is willing to take only 7,50,000 as the final payment, would you be willing to buy it? If he says yes, then we'll put the transaction to the stock exchange and 7,50,000, you get 7,81,000 worth. So instantly you get 31,000 rupees more and your interest earning will be more than 15%. So that also has to be democratized. But there is a catch here. What happens is in SDIs, the cash flows are coming every month. So after the last cash flow, if I want to liquidate my holdings and cash flow date, there is no accrued interest. But let us say 15 days henceforth, if I want to do that, there is a calculation mistake. If the platform like GRIP can really announce for all the open instruments what is the value that is along with the accrued interest on that day, then it will be easier for me to say, look, GRIP is saying that this instrument is worth 1,17,000 rupees today. And now this guy wants to get out, he wants to give it at 1,10,000 rupees. Are you willing to take it? That means 7,000 is the clear gain. So, like that, we have to have a mechanism where the real value with accrued interest should be displayed on a daily basis so that it becomes easy. But unfortunately, that is not there. So if we really come up with that, I'm telling you, this instrument will be more popular than probably many of the other equity instruments.
Yes, you are on mute.
You're on mute, Ash.
Sorry. I was just saying, Weber, any thoughts on that and any thoughts on Mr. Prasad's proposal also?
Yeah, so your question is bang on liquidity. Mr. Prasad said that I would be uncomfortable. I think he meant that P2P was far more liquid. However, we are not because see fundamentally how we have made the SDIs. They are listed tradable securities, right? See, technically they are supposed to be traded, so there can always be the angle of liquidity, and this is what we call as our liquidity feature, and this is one of the next big things on our roadmap. In fact, we have already piloted liquidity for corporate bonds. um, so and what Mr. Prasad said, it is basically if you can create that market, if you can do the market making plus liquidity, and that comes at a certain price, but with the convenience of liquidity for the investor, it all makes sense. Like that's how the markets deepen itself. That's how this will, uh, you know, uh, uh, in fact, all fixed income instruments will deepen the market in a way like this. There has to be one market maker, there has to be liquidity as a feature from an infra perspective, and then investors will be happy to pay a price of, let's say, 15 to 25 bips to assessing that feature. That's what Mr. Prasad was saying when he was talking about pricing. In case of emergency or when you want to liquidate, you would still make, let's say, a 12.5% return instead of 13% return, or 12.75% return instead of 13% return. For the access of that liquidity, most investors will be happy to pay that price, uh, and still, be much ahead of bank deposits, FDs, and so on and so forth. So, yeah,
And it's only
completely.
fair, I think, right? Weber, because even when you go and break your bank FDs, you have to pay 1% penalty in, most of the cases.
Yeah, like
So it's
consider
only
it.
fair.
Yeah, you're absolutely right. Consider even mutual funds have exit loads, right? For a
Yeah.
certain period of time. It's the same concept.
And sorry, just for the record, P2P lending now, based on the latest regulations from August 16, have no secondary market. So even if you enter into a P2P loan, you can't, there is no secondary sale of loans that is allowed by RBI. So effectively, once you buy a P2 or invest in a P2P loan, you can't exit it until the loan tenure finishes. Whereas
Yes.
in LoanX, there is still an option available, although the liquidity, again, like Mr. Prasad has also pointed out, is very less. The option is still available. Uh, and Weber, any thoughts on what Mr. Prasad said in terms of showing the accrued interest or the final price of the security also, like even for securities that you have already sold onto the platform, like principal plus accrued interest kind of thing.
Yeah. So see, what we have today, and I heard it recently as well. What we have today is if you invest 1 lakh in an SDI, this is your return schedule. This is how your return schedule looks like. That is very clear. You will see month on month what is completed, what is scheduled. so on and so forth. What Mr. Prasad means is, if I have invested 1 lakh rupee, can I every day track what that 1 lakh rupee has become now? Right? Now, there are two things to it. One, this is a monthly amortization instrument, which means a part of your principal keeps coming back to you. So it is not an accurate representation. People are used to your looking at your fixed deposits or mutual funds where the redemption is not happening. Your entire money is logged in, and the value will only increase unless there's an adverse event. Here, the monthly amortization happens. So your 1 lakh will become 90,000 the next month plus some accrued interest. Then it will become 80,000 plus some accrued interest. I think that representation is something that we'll have to figure out, which is easily understandable, so that people should not see that their value is actually decreasing. That is one. Second is, when you see, as a user, when you see that value, you feel like I can extract that value today by liquidating. And we were just on that liquidity point before this. I think until we get to that any day liquidity in this construct, it might be misleading for some people. But I take the point. We'll think about this representation somehow.
I mean, one thing I can tell you, Vaibhav, is people are not smart, but people are also vigilant enough. I can say investors will easily understand. They don't understand the face value. They don't need to understand because there is no face value concept in the kind of LoanX platform or SDI. What is the amount outstanding as a principal is what we need to show, and what is the amount of interest accrued till this date, that's the value. And tomorrow, if you see the same thing, it will go down a little bit. That is because the principal amount is shown separately and interest amount also is shown separately. If there is a repayment that has already left your system, then obviously the entire interest will go away and only the principal amount will stay there. So if we do that, even if people don't understand, in simple layman's language, what I'm going to say, I can say at least personally, I can commit about a couple of crores at least for this proposal. If this is going to be made available, I'll open the window for them. In fact, if not anything else, I will give a two-way quotes for all, not two-way quotes, one-way quote for all the SDIs. I will be a buyer at so and so price. So if you're willing to sell, sell it. Then liquidity problem is already addressed. All that I'm saying is, together, if you make the information available, and we know how to develop the ecosystem. Once the ecosystem is built in, there will be buyers, there will be takers, and I think it will give a lot of mileage to the extension of the concept also, I believe.
Okay,
Yeah.
awesome. Okay, no, very fair points, I think. Definitely something for Vaibhav to think about. Mr. Prasad, I want to ask, do you still distribute P2P lending as a product for your clients?
No, we stopped. As soon as the regulations have been announced by RBI with the strictures passed on some lending institutions, and which
Uh-huh.
unfortunately one of the institutions that I endorsed before was also one of the recipient of the strict penalties. So we spoke to them. They
Correct.
also landed down here. They said, "Sir, all the repayments would come to the people, but we don't want to do this. We want to go into the something else." I said, "Boss, the concept of no security is what I liked in your case, and then kind of being able to share the risk of the defaults at your end is what I liked. Now those two things are gone. I do not want to expose any of my clients anytime because I would be either giving them a better alternative or no alternative. But I cannot give them a worse alternative. So we stopped it. Now we are not giving even 1 rupee business to any P2P institution unless the clarity emerges and those features have been brought back.
Okay, got it. And which were these features, Mr. Prasad? Like, why did you distribute the P2P products in the first place? Like, what did you like about
See, the first place we like the concept because trusting people is always a good habit to do than trusting an industrial entrepreneur who has a big incentive to default. When they said it is only personal loans, and then next thing is we are lending to the people who do not require money, and then we are lending to the people who have got more than 750 credit score. These are the instruments which actually made it. And then because it is offered in such a way that if even if the defaults happen up to 17%, there is not even an interest loss for the depositors, we pushed it. And the moment that is taken up, for example, if I lend it to Ash through the platform, and if Ash some has a problem in repaying the payment, then I need to pay the price for that. Then that's not fair because I don't know even who Ash was. So obviously, evaluating individual applications and abilities of the borrowers at a depositor end is impossible to think. So I don't want to do that. I said, let us stop this. And anything that is open public acceptable mechanism is what I want to endorse for people. I not something else which is, looks fishy. It was not fishy, but now it is not fishy, I say, but it is made so redundant. I don't think anybody will survive with this set of regulations.
Got it. Okay. Thank you. Yeah, I think I'm done with all my questions on the topic. We have a lot of questions coming in from the audience. So I'll start picking them up. Some of them are specifically on grip platforms, so Vaibhav will have to pick them up. But first question from Aradhya. Is there any insurance for the LoanX product? Mr. Prasad, do you want to answer that? I think this is from Vivekam's channel.
Yes. And like, she said that, is there any insurance on this spot? First of all, insurance is for a defined risk. Unfortunately, in the LoanX platform or with these kind of instruments, the risk varies every month. Like, for example, you lend about a lakh of rupees, 10,000 rupees principal is repaid, 90,000 is the principal, and then 80,000, and then 70,000. After 7 months, it's all completely gone. So, who will offer the insurance? First thing you need to understand is, for an insurance to be in place, it should be insurable product, insurable business proposal. In this money lending, if somebody gives an insurance, everybody will default. So that's why I think insurance is not even feasible to think of. You need to understand that insurance is built in the form of 10% additional security, 10% collateral, additional interest, that is already 30%. That means unless 17%, more than 17% go. And apart from all of that, there is a famous saying, there is no guarantee for guarantees. At least in financial markets, if somebody expects their losses to be covered by someone, they are living in a fool's paradise. It is not possible to protect from the downside if there is a default. Why are the banks? Why is the government saying we will not reimburse you more than 5 lakhs? Even with the banks, there is a reason behind that. So obviously, expecting that is absolutely, I don't say is incorrect, but I'm telling you what we are looking for is something which is not feasible.
Got it. No, fair, very fair, Mr. Prasad. Vaibhav, question probably for you. What is the historic default percentage in A and above rated bonds? Do you have that data available at hand?
Yeah, good question. So I will talk about a tenure of 2 years for these rated bonds. A AAA rated bond has a 0% default. A AA rated bond for a 2 year tenure is 0.12%. An A rated bond for 2 year tenure is 0.43% default. If it goes below 2 years, the percentages decrease. So if we take a 15-month tenure for and chart the same defaults for these similarly rated bonds, the default percentage will decline. Having said that, 0.12 and 0.43% are very, very healthy default. I mean, it's an oxymoron. There cannot be healthy default rates, but these are very low default rates of the industry.
Okay, awesome.
And there is one
Uh,
question, I
yeah.
think, I'm sorry. RI just said LoanX versus SDI, more detailed analysis is needed. Which one is less risky? LoanX is an SDI. LoanX itself is an SDI. It's not like LoanX is different and SDI is different. We picked up the term LoanX because right now what is an offer is a LoanX, which keeps coming every month after month from a different vendor. So LoanX is an SDI. So it's not two are not separate.
Okay. And I think Aradhya has asked one more question for you, Vaibhav. Grip returns are lesser than its peers. Why is that?
Oh, very good question. So, see, Aradhya would not be able to respond, but I would like to ask, uh, who do they consider our peers as, right? There could be so many peers that you could look around, and there could be so many companies that you could look around and say they are their peers, but they are not. Now, let me break it down because it's a good question and good for the audience to hear. So, there are unregulated products and there are regulated products. Grip offers only and only 100% SEBI or RBI regulated products. There could be other platforms which would be offering unregulated products, and usually they will have higher returns to offer. Yash, you might be the right person to talk about what just happened a week ago. Uh, um, and there you will get higher returns, but the risk will be substantially higher. Not just the risk, your grievance redressal will not be in place because these are unregulated products. There's no regulator to help you with grievances. Having said that, now if you compare grip with only regulated products, we probably would be the platform to give the highest returns. Which brings me to the point to alts bond comparison tool, and which also investors can look at. So same security, if there is on different platforms, what are the returns offered? But I can fairly say without doubt that grip offers the best returns on comparable products across the industry.
And there's one
Okay,
question
awesome.
from Mr. Anil Kumar. He said
Yeah.
subprime crisis in 2007 started because of SDIs. It is not SDIs, that is CDOs. That was called collateralized debt obligation. So let us not try to coin our own terms and concepts that were existent before. So that was a collateralized debt obligation. When the housing loan bubble was being burst in America, when the loans were given to the borrowers, they were insured. Like Araja has asked, is there an insurance? Somebody has insured the repayment cycle, and when the entire repayment history went into a toss, everything defaulted. Insurance companies also turned around. We cannot pay. That's why subprime crisis happened. That is completely different. That may probably we can save the discussion for some other time. And to the Anil Kumar's issue, that SDI is not what was there. It was only CDO. And next thing is the popular perception of people is resistance to change, resistance to new things. People believe that anything that is new is fraught with a lot of risk. RBI and SEBI will not be foolish to permit an instrument to be allowed and offered to the public and subscribed and then being serviced by organizations without a reason. And in fact, I can tell you, even the government securities are open for retail investors only because RBI wanted it. So now the debt instruments are being brought to us. You need to understand, don't invest immediately, but seek clarification. They're trying to give out your opinion, expect someone to answer. So now coming to the SDIs, is it less risky because credit rating agencies also will misbehave? If you think will misbehave, anybody can misbehave. Your bank also can go belly up. Tomorrow, if the money is deposited in your bank, if they don't give it, so we cannot answer a hypothetical, too extensive kind of wild allegation kind of comments. We cannot comment or reply, but don't be afraid. Take your opinion, and if still not comfortable, don't invest. But remember to know, and you only are going to be the loser, not being able to earn more than bank, though the options were available right in front of you. Please understand it from the right perspective. I'm not trying to write you down, but I'm trying to make the perspective clear for all investors.
No, thank you, Mr. Prasad. I would just like to add to Mr. Anil Kumar's question. Even uh, in India, actually, Mr. Anil, when an NBFC or a bank is giving out the loan, they can't securitize that loan immediately. There is something called as MHP, minimum holding period. That's a RBI and SEBI regulation that you need to keep the loan on your books for a particular period of horizon, depending on the tenure of the end loan that is given to the borrower. So bank is not incentivized at all to just give out the loan and then securitize it immediately. That's not possible in India, which was the case in the US market when that happened. Banks were giving out loans at without checking any sort of credit history and then ultimately securitizing. That's not possible here in India. Banks are not incentivized at all to give out risky loans. They do their credit risk assessment properly, and then they have to hold it on their books for a period of time, and then only they can securitize. And even then, platforms like Grip would come in and do that assessment whether this uh, pool of loan is good or not, based on multiple assessments, which is their own proprietary assessment. But yeah, just another question on your channel, Mr. Prasad, from Praveen Kumar. Any minimum and maximum investment and time frame?
There is no maximum investment as I understand at this point of time. And their maximum investment is like crores of rupees. It's normally not considered. I have not come across any client who wants to invest crores of rupees. But minimum investment wise, minimum investment varies from every instrument to instrument. There were some instruments which are available for 70,000 rupees. There were some instruments which are available at 2.5 lakhs. So this is based on tokenization. Like after the money is pool of loans are pulled up, divided into number of units that is seem to be feasible, they come up with each value of the ticket size. So it will vary. Unfortunately, or fortunately, that is how the things are now. They cannot uniformly make it 10,000 rupees and 1,000 rupees like easily understandable thing is not still there in place. But as I told you at the beginning, if you start your journey with around 10 to 12 lakhs of rupees, with a duration of anywhere between 7 to 18 months of time, if you keep picking it up, every month you will be able to recycle the cash flows that are coming into you. So when I say 12 lakhs, either 12 lakhs or 24 lakhs or 36 or 48 or 16 multiples of 12 lakhs will seamlessly allow you to redeploy the cash flows for the same amount of return, which means working for 2 minutes a month, 2 minutes a month, you will be able to establish a return flow of 12.5 to 13% comfortably, probably even without tax if you deposit or if you use this instrument in your non-tax payable SSC in your household. Either your wife or father or mother, anybody, if you can do it in your name, probably you'll be able to save tax and then multiply the return manifold.
Okay, awesome. Thank you, Mr. Prasad. Weber, question for you. Please throw some light on TDS and also exemption form 15 in SDIs.
One thing,
So,
Vaibhav, one sec, just I want to add here. That's
Sure.
what many times I keep hearing from my investors also. They say whenever TDS is collected, they think it is gone. They think it is just gone forever for good. Though I keep telling them TDS is the amount, you don't call it as T tax deducted. You consider the tax deposited on your behalf with the government. The moment you start redefining the concept as tax deposit, not even tax, advance deposit with the government, which will come back to you after the due date of return. If you take it that way, then you will not be at a loss at all. I've been able to convince a lot of clients on that, and I will keep doing it. Please don't think tax paid is not not recoverable. It is 100% recoverable, but only thing is you have to give it a time. Let the government enjoy it for some time at least. Yeah, Vaibhav, sorry.
I think you answered. I think there's a misconception that TDS is just an advanced tax. In fact, I am one of those people who don't pay tax across the year and then pay penalty at the end of the year. Okay, TDS actually helps you save that penalty. Having said that, I mean everybody's has their own opinion. So on TDS is 25%. I saw a question why it is not 10%. That is the question that we are asking SEBI and the tax ministry, but it is what it is. And secondly, there though the provision of Form 15H very much applies. You can file a Form 15H and apply for an exemption on TDS if you don't fall into a tax bracket. Um, and We can help you with that. We have helped a lot of investors to get their Form 15H filed and applied. So Form
Okay,
15H is
awesome.
basically applying for an exemption from TDS. That's what Form 15H is.
Yeah. Okay. Weber, next question for you. We have extra repayments for almost all the SDIs. While the XIRR remains same, will the absolute gain be lesser than that displayed while investing?
This question can come only from a very engaged regular investor in LoanX and Mr.
Yeah.
I didn't catch the name, but yeah,
Parag Mehta.
yeah, Parag, you're absolutely right. The prepayments from the borrowers do happen in SDIs. That is only a positive sign that the pool is behaving even better than what it was anticipated to do. So there are prepayments. The prepayments reduce the risk of further reduce the risk of instrument. You are also right on the other point that your XIRR remains the same, but because the money comes back to you earlier, the absolute returns might be marginally lower. However, it is not fundamentally different. They just marginally be lower because of the higher prepayments.
Okay, awesome. Another question, Weber. Bring in CDS, credit default swaps, also for these instruments that will make the instrument risk-free for retail investors. I just want to add, if we bring CDS, which I don't think is possible, you have to pay a premium on those CDS. So then you'll only earn risk-free rate. So why to go down that route? Just invest in a government bond. But yeah, please answer.
Yeah, the question is fair. Your answer is fair. CDS is basically goes back to the first question of this webinar, that is there an insurance for this product? CDS basically is an insurance to the product. But and it is not allowed. We might bring that as well. However, what Yash
Okay.
said is also right, that uh, right now you are in the range of 12 to 13% returns. If we bring the insurance, which makes it further risk free, the returns will further come down. And yeah, investors can choose their risk appetite accordingly. However, even in its current form, as Mr. Prasad also said, it is quite a robust product. So it does not immediately require an insurance right now.
Okay. Another interesting question from Arpit, again for Weber. If the invested principal is not getting impacted till 25% default, then why is it not getting AAA rating?
Okay. So see, rating is based a bunch of different parameters. Rating is based on the originator or the NBFC that is involved, the pool quality, the other parameters that I just described. It also goes into it will become technical, but is it a turbo party? I'm trying to find out easier words, but whether only interest characterizes the default, or interest plus principal both characterize the default. There are many factors that determine the rating of a product, and not. However, having said that, SDIs are rated higher than the originator. So if an originator is rated as A minus, the SDI of that originator or LoanX of that originator will be rated A plus. And that's where the delta has come, where the security structure is in place, which leads to a 25% cover, which leads to a two notch higher rating than the originator. So every instrument cannot be rated AAA like that.
Okay, awesome. One more question. There are 4, 5 rating agencies. How does a common man know which one is best? And follow-up question is, can GRIP stick to one reputed rating agency?
See, all rating agencies are good. There is the we work very extensively with all rating agencies, and the kind of work that they do are is similar in terms of the analysis, the data requirements, the toughness of the assessment, and so on. However, there's a general conception that CRISIL, ICRA, and CARE are your top rated agencies. Now, even if I take this question, if you go and look at GRIP's opportunities, 90% of the products will be rated by either CRISIL, ICRA, or CARE. So in a way we are there because, and just by the nature of the work they do, the larger work they do, we also end up with working with these three agencies more than the others. There's one more agency which is Acute, but these are just the 3 4 agencies, and depending on where the originator has worked with, which agency is free to take up this, we decide on the rating agencies to work. But these are all good reputed agencies.
Awesome. Question for you, Mr. Prasad. What about the already lent amounts on P2P platforms for a year or two? So let's say if they lent amount last before the regulation came in for 2 years, what happens to that amount?
Nothing happens. No, it will come on the date of the day, kind of repayment schedule, because many people have taken the window of 3 months lock-in. Every 3 months, it automatically comes. Some people may have opted for a 1 year lock-in period. Now the regulation says, is not even says, the regulation is very quiet. It will not allow lending in kind of P2P institution whether to go ahead and repay or not to repay. They are not cleared, and they don't know whom to ask. If they ask, there may be opening up a Pandora's box. So that's why they are sticking to the repaying on the date that is scheduled. The cash flows are coming in and sitting in their bank account. They cannot even prepay because it may be viewed as a violation again by RBI. So in the absence of the clear guidelines by a regulator, they are caught in a fix. So they are releasing it as and when it is due for the investors. I have not come across single investor to come to us saying that my installment is due, it has not come. Everybody is getting on time. So I think there is no default risk brewing in at least peer-to-peer lending.
Okay, got it. We'll take probably last question because we are out of time. Weber, So Gopal has asked talk about Form 15, but I would request Gopal to probably reach out to the relationship manager at GRIP, or if you're in touch with Vivekam, I'm sure Mr. Prasad's team will be able to help with that. Another question from Gopal is, can you mention simple interest rate instead of XIRR, which is difficult to understand on the platform? So Vaibhav, do you want to comment on that?
Actually, I just wrote a comment on that. XIRR, I will just keep it short because we are almost at time and maybe Mr. Prasad can also add. But XIRR is the more accurate metric when principal repayments happen on a periodic basis. Interest rate is the more accurate metric when there are no principal, actually where there are no principal when there are no principal repayments happen. So we are more attuned to interest rate because traditionally in FDs you put 1 lakh, you will keep it for 3 years without any principal repayment, and that's why the interest rate is equal to XIRR. When principal comes back to you, then the interest only applies to the principal that is now invested. So 100 rupee you invested, 10 rupees comes back, then the rest of the interest only applies to 90 rupees. Hence the absolute yield is not the correct metric for such instruments, and that's why XIRR is used, which takes the time value of money.
In fact, if I may add a little more sense in this, that's why I always try to balance between these two basic misunderstandings. Somebody thinks that money coming as interest over a period of time has to be computed because, as Vaibhav said, the principal is getting repaid every month after month. If you add up the interest amount received at the end of 12 months, obviously it will be less than the simple interest which you thought was possible around 13%. So, to avoid this confusion in the people's mind, that is why I came up with an idea that if you start with 12 lakhs and don't touch the money except for reinvestment and recycle it for a year or 2 years, you end up getting around 12 13% interest. Because every month you get cash flows, you reinvest. Every month you get cash flows, again reinvest. That's how it should be compared apple to apple. Otherwise, you cannot compare two differently defined instruments into the one mold and then say, show me where the gap is. Simple interest is different, which is difficult to understand unless you do the reinvestment automated. I think that would probably answer most of the people's concerns that they are going to get 12% if they stay invested like a bank. If you invest for 3 years and recycle it, you will get 12%.
Awesome. Okay. I think we're done with all the questions. Any closing thoughts, Weber or Mr. Prasad?
Yeah, from my side, my
No?
request to Vaibhav will be to disclose the value of the each instrument that is still in circulation with the accrued interest. If he, the faster he makes it, the faster I will be rolling out the window to kind of buy and then give a buy code for most of the instruments that are open on any day.
All right.
Awesome.
So I don't think that is a disclosure that we don't do. I think it is more about representation on the website that Mr. Prasad is asking, and I have taken a note of it, and we will work towards it. On closing thoughts, Yash, I think this is one of the webinars that I've spoken the least, and happily so because Mr. Prasad has, and I didn't expect that coming into this webinar, but I think Mr. Prasad has been a great advocate of SDIs, and for all the right reasons. Like if you heard him saying about banks doing this, large institutions doing this, why are retail investors not doing it, lack of fixed income options, volatility in equity markets, and we are still hoping for that equity markets. I'm seeing questions on whether we should buy Adani group stocks right now. Like that is the kind of difference in awareness that there is. At Grip, we do what we do. However, if more of such large advisory institutions like Mr. Prasad create this awareness. I'm not even talking about distribution of SDIs, but I'm talking about awareness in at large. That is very heartening to say, and I think Yash, you have been doing that fairly well at Alt Investor. There are still questions around understanding of regulated versus unregulated products and these things. So yeah, it's great to be on this forum to talk about these things.
You are a good host,
Thank you,
Ash.
Weber.
I mean, I must say that you're a very good
Thank you.
host and you have the balance of mind to really not like like speak too fast, neither speak too slowly. You're a perfect host. I think I enjoyed interacting with you.
Thank you, thank you. Thank you, thank you. And thank you so much to our audience also who joined the webinar. Thank you again, Mr. Prasad and Vaibhav, for sharing your insights transparently and, of course, effectively with the wider audience. If the audience has any more questions and you haven't had a chance to ask them here, want to ask them privately, you can reach out to me. My email address is yash, YASH, @thealtinvestor.in, or you can join our alt investor community if you are not a part already. Just search for alt investor community on Google. If you did like this webinar, please don't forget to like, share, and subscribe the Vivekam channel and the Grip Invest channel. Both the channels spread out a lot of awareness and in their own respective regions. So definitely stay tuned. And thank you for tuning in and have a great day ahead. Thank you.
Thank you, Ash. Thank you,
I'll
Vaibhav.
just
Thank you.
thank you.
Thanks.
I've just stopped the feed, Mr. Prasad and
Yeah.
Vaibhav, but yeah, I think it was a great session. Uh, Thank you so much. Really appreciate it.
Yeah. Thank you. Thank you so much.
Thank
Thank
you.
you.
Thank you.